This is Tony Eddolls with PRMG, and today I wanted to talk to you about a proven and beneficial strategy that could save you hundreds of dollars, if not more, every single month for as long as you're in your current home. But before I begin, I just pass along my best wishes for your health and hoping that you're making the best of the current state of things in Colorado, where we're all on kind of a partial lockdown as coronavirus continues to spread in certain parts of our state. I'm at home in Lafayette, northwest of Denver, and the traffic is running at about 50% or less of its usual volume, and open stores are ghost towns. But it's fair to say that despite the loosening of some of the guidelines, we will need to be really careful. It's a challenging time for a lot of people, and so I'm really emphasizing the value of what I'm talking to you about today. Refinancing your existing home loan, consolidating your debt, and converting those debts from high-interest credit cards and car loans to a low-interest 30-year mortgage. And also putting some of that cash into savings or investments that currently is equity in your home. This really makes a lot of sense. Of course, this strategy isn't right for everyone, and some folks don't have the equity right now that's needed for it to work. But especially right now, when uncertainty is prevalent, the timing of this unique strategy is undeniable. So I'm going to take you through the process and show you how it works and invite you to reach out and allow me to take a look at your own situation. Let me demonstrate precisely how refinancing and paying off all your debt can work for you, even if your rate isn't that far above current rates. So stay tuned and let's take a look. So let's take a look at how this can work. I'm going to show you a real example, and just know that my job is to review your situation individually so that we can determine whether this strategy will work for you. In this case, the client bought a home in Denver in 2010 for $300,000. Believe it or not, real data supports the fact that this home has appreciated, has grown in value to $669,035. We've had a great run to this point since the Great Recession, but there are real concerns that those values could begin to drop as the impact of the coronavirus hits our economy. However, today, values in the mid-range in our community have not yet begun to fall. So, as you can see, this client currently has over $450,000 in equity in their home, and they can access up to 80% after they have paid off their first mortgage. The rate is 4% on their existing first. So right away, we're able to give them a rate reduction as we can drop their rate on a cash-out refinance to around 3.5%, which, by the way, would be an APR of 3.671. They also have $48,500 of other debts, such as car and credit cards. Not bad, really, compared to a lot of families, but all those debts are at a much higher interest rate. So the simple way to look at this is that we can take that first mortgage along with the minimum payments on all their debt, and we can pay everything off, and we can be left with just one payment, our new first mortgage. This new first mortgage would increase over their existing loan, but their overall debt would not increase. And as you can see, we've really lowered their payment, which in itself provides a great benefit. But there's a different strategy to look at, and you'll be amazed at how it can work. Let's demonstrate what would happen if this client were to continue making the same payment each month as they are currently making. After all, they've been doing this for years, shelling out right about $3,000 per month for their mortgage and all their payments. Look at what happens if they continue paying that extra month to their mortgage lender as a principal reduction. Look at how quickly they are able to pay off their mortgage, which would include their existing credit card debt and their car loans, all of it. In 9 years, this client would literally be debt-free. It's hard to believe how quickly you can pay down a mortgage when you make principal reductions, and which includes debt that currently is being paid off on an after-tax basis. However, if we convert everything to a mortgage, interest on up to $750,000 of mortgage debt can still be written off or deducted in 2020. So there's that benefit as well. Now you can see how beneficial this strategy can be. Not only can you reduce your mortgage interest rate, but when you include your other debts, you can lower your overall payments significantly. In the example we just showed you, by over $1,000 per month. But we also showed you another strategy, the amazing outcome of making monthly principal reductions by continuing to make the same payment you're currently making on all of your debts. But instead of making those payments to high-interest credit cards and car loans, you're contributing to the reduction of principal owed against your home. Keep in mind that not everyone's results will be the same. So what I'd like to suggest is that you reach out to me. Use the button below to contact me immediately, and we'll review your situation individually and see just what the impact to you and your family would be. Or just give me a call at the number below as well. Also, below, I've provided you with easy access to my secure portal that allows you to begin your application right away. If you've already recognized that a refinance would be in your interests, then let's get started. Let's face it, these are uncertain times, and who could say where home values are going to be in 6 months, or interest rates for that matter. Those of us in the business all wish we had a crystal ball, but what we do know is that for now, values haven't moved and interest rates are low. So if you think there's even a chance that a rate reduction refi or an equity recovery and consolidation refinance could benefit you, I'd love to give you a little extra security in these times. Until then, stay healthy, stay happy, and I'll talk to you soon.